Hello and welcome back to Gold Rush Reporter, your go-to channel for no-nonsense analysis on gold and silver markets. I'm your analyst, breaking down the numbers, the charts, and the stories behind the headlines. Today, we're diving into a question that's been buzzing among silver stackers. Did they really shut down the Chicago Mercantile Exchange to suppress silver prices? Was it a technical glitch or is something bigger going on? We'll unpack the entire event, the implications for silver's price, and what it means for physical buyers. 2025 has already been a historic year for silver, with record highs and extreme market volatility, and this outage just adds fuel to the fire. Traders and stackers alike have been scratching their heads over what happened late on November 28th, when a data center cooling failure halted trading across CME's futures and options platforms. Everything from silver to crude oil, S&P 500 futures, FX pairs, and US Treasuries was impacted. And the timing? Suspicious, to say the least. Let's be clear. The CME acknowledged the issue just a few hours before the halt, citing a cooling problem at Cyrus 1 data centers. Bloomberg called it unprecedented. It wasn't a minor hiccup. Trading ground to a halt for nearly 10 to 11 hours, affecting trillions in notional value across multiple asset classes. Traders in Singapore and London were frozen out, screens stopped updating, and chaos ensued for anyone relying on real-time pricing. Now, silver was trading near all-time highs, just as the outage occurred. Naturally, speculation skyrocketed. People wondered if a major fund manager, possibly Highland respected, known for significant positions in silver, was trying to leverage this pause to accumulate more metal. Could the timing have been orchestrated? Could it have been a coordinated shutdown to manipulate prices? Here's my take. It's complex. These systems are intricate, with multiple redundancies, nanosecond-level matching engines, and layers of technology most of us don't fully grasp. A cooling failure alone could trigger a chain reaction, and the fact that so many markets were simultaneously affected points to a technical fault rather than a deliberate market manipulation. Even so, the aftermath matters. Once trading resumed, silver didn't crash, it surged. People rushed in, panic and opportunity mixing together. This reflects something fundamental. Silver isn't just a paper number. The physical market, the tangible ounces in hand, still dictate real value. Holding silver is what matters most in times of stress, not fleeting futures contracts or ETF movements. In this video, I'll break down how this outage interacts with open interest, physical supply, and what it could mean as we approach potential market pressures in 2026. But first, let's get a clear picture of why this wasn't likely a conspiracy, yet why the market reaction tells us so much about the fragility of the system. Now that we've set the stage with the CME outage, let's talk about what it actually meant for silver and the broader market. When trading froze, open interest in silver futures didn't vanish. It was still there, looming like a ticking time bomb. As of November 28th, open interest on Comex for silver futures stood at over 118,000 contracts. That's more than 590 million ounces of paper claims on metal that physically doesn't exist in the vaults to cover every contract. Here's the key takeaway. The system is leveraged, and leveraged means fragile. The outage didn't create this fragility, it exposed it. People panicked, thinking, what if this is manipulation? What if they're trying to suppress the price? And naturally, the first instinct for many stackers is to buy physical silver. That's where real value sits. Metal in your hand, not promises on a screen. At the same time, we've got huge players quietly accumulating. Big fund managers, hedge funds, and even industrial buyers are watching the market like hawks. They know that the more paper contracts float above real silver, the more potential there is for stress in the system. And when Asia and India continue absorbing physical silver at record pace, The West can't keep replenishing London or Comex inventories. The math doesn't work indefinitely. Some people have argued that this outage was a deliberate act to prevent a spike in silver prices. I disagree. The outage impacted nearly every major market globally, not just silver. From S&P 500 futures to crude oil and US Treasuries, the disruption was widespread. That's not the signature of a targeted manipulation. It's the signature of a systemic vulnerability being revealed. What's important for us as silver stackers is understanding the lessons here. First, futures and ETFs are tools, but they're fragile. Physical silver is your anchor. Second, major moves in paper markets don't always reflect what's happening in the tangible world. Third, when stress occurs, prices can swing violently, not because someone is controlling the market, but because the leverage amplifies every reaction. Looking forward, this incident foreshadows potential turbulence heading into 2026. March, in particular, is shaping up to be a critical period. Open interest will remain high, physical supply tight, and any disruption could spark extreme moves in price. As stackers, investors, and observers, our best strategy is to remain informed, stay critical, and hold our positions wisely. Finally, let's remember, silver isn't just about short-term price swings. Its value is enduring, driven by industrial demand, investment appetite, and scarcity. Outages and technical failures can rattle the markets, but the fundamentals remain unchanged. And that's the story we need to focus on as 2025 heads into 2026. Understanding risk, watching supply-demand dynamics, and keeping our core silver holdings secure. Now let's dive deeper into what this all means for physical silver versus paper silver. The Chicago Mercantile Exchange outage was a stark reminder that paper markets are fragile. Futures contracts, ETFs, and other derivatives are essentially promises. They represent silver, but they are not silver itself. And when the system is stressed, those promises can't be fully honored. Right now, the LBMA, COMEX, and other major exchanges are sitting on hundreds of millions of paper ounces. Yet physically available silver is far lower. In London, after accounting for ETF and vault holdings, only about 140 million ounces were truly available at one point in October. Meanwhile, daily trading volume exceeds 700 million ounces. The numbers simply don't add up. That's leverage, and leverage equals risk. Asia continues to be a major driver. China's Shanghai vault stocks have dropped to around 39 million ounces, levels not seen in a decade. India keeps absorbing silver through industrial demand, investment appetite, and seasonal purchases around festivals and weddings. The West cannot refill London fast enough. Physical silver is being drained from vaults globally, and when that happens, paper claims are exposed as what they really are: just paper. This sets the stage for March 2026. Comex silver futures for that month currently show open interest at over 118,000 contracts, roughly 594 million ounces of paper silver. Registered inventories, by contrast, are far smaller. Even a small fraction of contracts standing for delivery, say 5 to 10%, could create severe stress on the system. That's the structural risk we've been warning about. It's not hype, it's math. Investors and stackers should understand this. Physical silver is your security. Futures, ETFs, and other paper instruments are convenient, but they carry counterparty risk. When the physical supply gets tight, price swings are amplified. That's why Hansa Czerny and other analysts emphasize that what we're seeing isn't just a rally, it's a repricing. The market is beginning to reflect the real scarcity of silver, not just the paper price. And make no mistake, March 2026 isn't just another futures month. It's potentially a stress test for the entire paper market. If a significant portion of contracts demands physical delivery, we could see violent moves in price and liquidity challenges across exchanges. This is when fundamentals collide with leverage, and the result could reshape the market landscape for silver in 2026. In the meantime, keep a close eye on both physical supply and open interest data. Diversify within your silver holdings and hold your core positions tight. Understand the distinction between what exists physically and what only exists on paper. The next few months are critical for market observers, stackers, and anyone holding positions in silver. As we move closer to the end of 2025, it's clear that silver is in uncharted territory. Prices are near all-time highs, physical supply is tightening, and futures markets are more leveraged than ever. With all of this pressure, the natural next step is a consolidation, or even a significant pullback. That doesn't mean the rally is over. It just means the market is adjusting to stress and uncertainty. When futures and ETFs dominate price action, volatility can spike without warning. One moment silver is climbing past $56 an ounce. The next, a technical glitch or unexpected liquidation can push prices sharply lower. These moves are amplified because paper silver dominates the market. Real metal is scarce, and when buyers demand physical delivery, the imbalance is exposed. That's why the CME outage in November was such a wake-up call. It highlighted how dependent the market is on infrastructure and promises, rather than tangible metal. The looming March 2026 futures month is where all of this pressure could converge. Open interest is massive, and if even a fraction of contracts stands for physical delivery, it could strain Comex inventories to the breaking point. Some analysts suggest a 5 to 10% physical stand could cause extreme stress, while anything above that could force rule changes or even default scenarios. This isn't speculation, it's math. Futures contracts are leveraged promises, and when they meet real-world scarcity, tension skyrockets. For stackers, this is a critical moment to assess strategy. Physical silver should form the core of your holdings. It isn't affected by paper manipulations, exchange glitches, or technical outages. ETFs and other paper instruments offer convenience and liquidity, but they expose you to counterparty and structural risk. Diversification is key. Hold a mix of physical silver types, consider miners stocks for additional leverage to the silver price, and use paper markets cautiously, if at all. Expect volatility as the year closes. Seasonal demand in India and Asia will continue to tighten global physical supply. Price spikes or pullbacks will create opportunities for those holding physical metal. But don't be swayed by hype or conspiracy theories. Markets move for a reason, and understanding fundamentals versus paper dynamics is essential. Ultimately, silver is revealing a truth that's been ignored for years. You can't print metal. The disconnect between paper promises and real supply is shrinking, and the market is starting to price scarcity. Those who understand this, hold physical metal, and stay patient will be in a strong position when the inevitable stress test occurs in March 2026. In short, watch the supply, watch the open interest, and protect your core silver stack. The next few months could redefine the silver market, and preparation will make all the difference. So here we are, looking at the tail end of 2025, and it's safe to say this has been one of the most remarkable years in silver's history. We've seen record highs, unprecedented volatility, and physical demand outpacing supply in ways we haven't seen for decades. The November CME outage was just a reminder of how fragile the paper markets are when compared to real physical metal. Looking ahead, March 2026 looms large on the horizon. Futures contracts are at historic open interest levels, and even a modest portion standing for physical delivery could create severe stress on the Comex. This isn't speculation, it's basic math and market mechanics. the silver market is being tested structurally, not just in price terms. Those holding physical silver are in the best position to weather whatever comes next. Paper claims, ETFs, and leveraged positions carry risk. Risk that will be revealed as scarcity tightens. What we're seeing now is the market pricing in the reality of physical scarcity. Supply is finite, global demand is rising, and the paper system cannot create metal. Asia, particularly China and India, is absorbing silver at record rates. Western markets cannot refill London or New York inventories quickly enough, and that tension is translating into both price volatility and the potential for real stress when contracts come due. For anyone stacking silver, the message is clear: hold your core physical stack tight. Diversify within the space, different forms of physical silver, miners, and cautious paper positions. But understand where real security lies. This is not the time for speculation or chasing hype. It's the time to think critically, understand market fundamentals, and protect your position. And this is exactly what this channel is about. Here at Gold Rush Reporter, our goal isn't to pump silver or any other commodity. Our mission is to analyze, explain, and provide actionable insights so that you can make informed decisions. I don't take orders from anyone, and I don't chase trends just to get clicks. What I do is break down the facts, highlight the risks, and give you a clear picture of what's happening in the markets that matter most. So, as we close out this year and prepare for 2026, keep your eyes on the markets, stay vigilant about supply and demand, and above all, continue holding your physical silver. The events ahead could test the system like never before, and being prepared is the key to navigating whatever comes next. Thank you for watching, for engaging, and for being part of the Gold Rush Reporter community. Don't forget to rate, share, comment, and subscribe so we can continue to bring you the latest analysis and insights on precious metals and the markets that shape them. Stay informed, stay critical, and most importantly, stay stacked.